The top two states which I'm personally buying in most myself and for clients, like we buy right throughout Australia, which is Queensland, New South Wales, WA, South Australia. My two favorite, Perth, Queensland. Picked up houses back in like 2021, like 280 in Brisbane. 2-3 years ago, same properties now is like 550. It going from 280 to 550. It's almost double. It's like 90% up. Be surprised how many people said, oh, I'm not buying this property for 280, and now they're kicking themselves because it's worth 500, 550. If you buy the property, like you're just buying it at a different time of the cycle. Yes, it has a lot more growth, to be had in it because you got the Olympics and infrastructure. Because it's gone up so much already in the last 1 to 2 to 3 years, that means the yields have deflated. So that property, the houses that we were picking up for 280, 300 originally back in 2021, you could rent them back then for like, 400 a week, which is great. Buy them for 280, 300,000 back then, rent them for 400, yield set 6-7% for a house. But now since the houses have gone up to, 500, 550 on average, the rents have gone up too, but the rents have gone from like, 400 to 500, 550. You pick them up, a house up now for 500, rents out for 500. So, a 5.2% yield. It's okay. We picked up a house as an example in Perth 2 weeks ago. We thought it was only going to rent out for 500 to 550. It rent out for 600 and we paid 350 for it. Growth in itself, I look at it over a very long-term period because investing in property is a very long-term thing, right? Over 15, 20, 30 years, PDF that I'm looking at right now, which is from Australian Bureau of Statistics and CoreLogic, it literally has from a 30-year period from 1990 to 2019. Brisbane, Perth, Sydney, on average over that time, when you compound it and break it down year by year over a 20 to 30-year period, like they all average 5%. Buy a property in Brisbane or Perth or Adelaide or Sydney back in 1990 at that particular median price of what it was in that location, you'd be averaging 5% growth no matter where you bought. Perth as an example, you're buying properties cheaper right now. Like I've got a property picked up today for $395. Owners bought it brand new for $460 in 2015. It went through recycle and inflated, then it went flat to the side. Queensland did the same thing actually. We bought properties in 2020 in townhouses and houses in Doolandella in a suburb of Brisbane. 3 years prior to that, in 2017, they sold brand new for 400,000. In 2017, I bought them in 2020 for 250, 150k less 3 years later. A lot of people don't actually understand you can have a positive cash flow to council rates, board rates, management fees, all that stuff, and interest, but then it can still be negative geared. Let's say you bought a property hypothetically, right, for like 400,000. And it's rented out for like 520 a week or 550 a week. So the yield's about 7 or 8%, let's say 8%. Your interest rates, let's say 6%. So you got 2%, 8% minus 6%, you got 2. That 2 pays for council rates, water rates, management fees. So let's say you positive cash flow by $50 a week. You buy a property that was built in 2016, so it's only like 7 years old as an example. You'll get what they call the Division 43, like tax depreciation benefits. So like you might get like $5,000 a year in depreciation benefits from that property. Like positive cash flow by $50 a week, which $50 a week times 52 weeks in a year is about $2,000. So your positive cash flow $2,000, but then your negative in gearing by $5,000 through depreciation. So technically your positive cash flow property is negative geared by $3,000. Different states have different purchasing laws and processes, and some states don't have cooling off periods, some do. Common questions that I get asked all the time: why would someone sell for $350 when it's worth 400, 410 as an example? Some people are very skeptical like that. How to get a property actually under what it's worth and below market value, below market comparables and sales, etc., is finding a property that has usually 2 things going on in the background. The first thing is usually the seller has like a time constraint. As an example, the seller has a time constraint. They need to sell the property in the next 30 to 40 days. As an example, it's a financial issue, it's a distressed sale, it's a bank repo, it's a divorce sale, committed to buying something else, and they've got to offload one of their current properties to get the funds for the next one. It's where they've really got a time constraint. They've got to sell in the next month or so, as an example. If you have only a short deadline to sell something, usually you've got to adjust the price accordingly. The second thing which usually fuels that part of how we're able to get a property below, for 350 when it's most other ones are going for 390, 410, and getting it under where you're making that equity on the way in more or less, is that if the property has what I call accessibility issues, meaning sellers that usually will allow for a lower price or be more motivated will be able to get it for a lower price if it has a time constraint, but also if they're a tenant in the property as an example, and the tenant's on a fixed lease for the next, let's say, 12 to 18 months. Let's say hypothetically right now there's a seller, they must sell due to whatever urgent reason they have in the next 40 days, but they've got a tenant in there on a fixed lease till March next year. You can imagine if they put on the market and do an urgent auction, an owner-occupier that wants to buy a house to move into that month or the next month, they can't move in because there's a tenant locked in there till like March, April next year, right? So it gets rid of all the owner-occupier competition. People that would normally buy the property, maybe only 2 people are actually willing to buy it and wait 12 to 18 months to actually physically move into it. When it has that accessibility issue and time issue, that's where you can actually, strike and get a property for far below, and actually be in a good position to get it under what it's worth. So those are the two underlying reasons. They're not very well talked about. When a seller needs to sell and they've actually got a tenant on a fixed lease, they're in a bad position in terms of getting the highest price. Those are the two most common reasons, yeah. Behind those, we get access to many properties. Sometimes we'll have to sift through 100 properties in a month, as an example, just to get 10 or 15. The three sources that we get properties from, sometimes it could be like a bank repossessed property from a bank administrator. It could be a public trustee that has a deceased estate. It could be a real estate agent, as an example, that I've bought personally, 5, 10, 20 properties off that are built good, because I've got hundreds of real estate agents across Australia in different states that we focus on, that built relationships over the past decade. And when they have a seller, not all the time, but when they do and they have a seller that's really motivated, they'll sell it off market. Educate yourself by reading property investment books. There's this book over here that I've got. I can obviously teach you all about it, 30 Properties Before 30, so you can check it out. You can actually get that for free.